Okay, shall we begin?
Yeah, I am ready.
Okay,
Actually, no,
guys,
I am
let's get
not ready.
started. What? Okay, sorry. Sorry, guys. 1 second.
I am not ready because I'm not sharing the right screen. Yeah, I'm not sharing my right screen. Give me 1 second. Okay, now I'm ready.
Okay, let's get started. Welcome again, guys, for the third time to day 3 and our last session for money spring cleaning. Yay! But also it's kind of sad. Yeah. So today we're gonna go deep into investing, pretty much automating how to automate your investments. So that's why we call it set it and forget it investing. And before we get into it, just some disclaimers again. Seb is not a financial advisor. None of what we're sharing here is financial advice. And before investing in anything, you should definitely do your own research. And yeah, we have to say this for every workshop. Yeah.
Uh, this one in
Okay.
particular,
Yeah.
because there's a lot more things that we might be saying that you should definitely not take as financial advice. Just want to
Yes.
really preface that.
Yes. Okay. And if you are here for the first time, I mean, I guess most of you, I recognize most of your names. You should probably already be familiar with Slido. So yeah, that's what we are using on the right side of the web page to ask you guys questions. I mean, for you guys to ask us questions as well as for us to go through some polls and questions with you. So again, first question of the night: how's your energy? Monday again. I remember last Monday everyone was quite meh. So let us know. Is it better this week? Put back the slides. Okay. So today we're doing all things investing, right? So here's a list of what we're gonna cover. First of all, for us to tell you why investing is really powerful, some realities of investing that you may not know, and a few things that you need done before actually getting started on investing. We're gonna go through different investing opinions or options, rather how you can automate your investments in 15 minutes and how you can split them up, as well as go through how passive income works and introduce you guys to robo advisors. And yeah, you guys are seeing CS today. He actually has been here for the past 2 sessions, just that he never showed his face. He was like behind the scenes dealing with all the tech stuff, but he will be the one covering the investment portion today. So if you all don't already know him, he's the co-founder of SAF, but I'll just let him introduce himself.
Yeah, thanks, Joey. So yes, I have been here every single time, just in the background, like Joey says, dealing with tech. But super happy and honored to be here, getting to share some of my thoughts on investing, and that's why I've also want to preface the initial part of like, yeah, these are my thoughts and Sav's thoughts, and they're not meant to be financial advice or anything, right? But kind of high level overview. As you can kind of tell with my accent, I was born and raised in Canada. I made a lot of mistakes with when it came to money, especially investing, before I actually learned to have a healthier relationship with it. If we have time, we will kind of, if you want to know more, I can share that. Before COVID, so right now I'm actually living in Malaysia. I moved to Malaysia 6 years ago to work here, and I was actually able to travel 3-4 months a year before COVID, right? And on not that much of a salary, so 10,000 ringgit, which is what, 3,000 Sing dollars now. Um, so yeah, did a lot of traveling. I really enjoyed it, and now I'm just really, working full time on Sav, trying to create more experiences like this for you guys, and help avoid you guys making the same mistakes that I made, right? And that's ultimately the main thing I'm really here to, I guess, contribute. All right. That said, what's the next slide here? Ah,
Yeah, just a
yep.
little question for those of you who haven't started investing. Let us know why. If you have started, then don't need to answer this question, I guess.
Hold on. Let's
Or
change the
maybe you can answer
screen.
why haven't you invested more? Yeah. But if you haven't started, any reason why you haven't started saving my emergency funds? At least you are saving your emergency fund. That's a very good start. Don't know where to start, scared to get scammed. Any more reasons why you guys haven't started? Oh, while we're
Yeah,
waiting,
yeah.
yeah. Wow, okay. Anyway, while we're waiting for more answers, Kim asked, why did you move to Malaysia?
Good question. So being born and raised in Canada, so Toronto in particular, I've never really had, I mean, the only time I've ever gone abroad was really for vacation or what have you, right? But I was actually part of a student organization that actually facilitated a lot of these opportunities to work on volunteer in other countries, and getting a chance to hear like, how great of an experience, a life-changing of experience a lot of these people had really made me want to do it myself. So yeah, like after I finished kind of working my first job and I had an opportunity to, redefine what I really wanted, I decided that, you know what, let's actually, let's actually live in a different country, live there, work there for a year or two, and then reevaluate. It just so happened that a year or two became 6 years now.
Anyway, let's get back to the poll. Seems like the majority, oh my God, look at that scared word. It's so big. But like, I guess the most of you guys are scared of investing, not sure where to begin, very daunting, uncertain, confused, too difficult, no time. Okay, no time. That one is a different reason. Lah. And then somebody said, just now I saw somebody said, I've already started. What are you talking about? And I just want to say, very good to that person. Too many options. Yeah. So, regardless of what reason you have for not starting, they could potentially be, subconsciously put into your mind through certain things that people have said about investing, or it could also be like your parents or how you were brought up. So we're going to start off with going through some myths that are commonly thought by people and telling you the truth, the actual truth. Yeah. So let's get into the video.
Okay, I'm assuming I'm pressing the button. All right. So I actually don't know what you would have said since I am recording this from the past, but I would like to hazard a few guesses as to what some of you guys might be feeling when you think about investing in general. So the first myth here is I will lose all my money investing in the stock market. I completely understand where you can hear these things. There are so many stories out there of people, losing pretty much everything investing or in I would question if it's investing or if it's gambling, but losing a lot of money in the stock market, right? And it does bring in a lot of fear. And we will cover a bit more about this. But the reality of it, or the truth here, is that different investment options have different risk levels, right? And diversifying and understanding your risk tolerance is important. We will talk briefly about some of these concepts later on. And ultimately, the main thing you have to really remember is that history has shown that the market has consistently recovered from downturns over the long term, right? So yes, it might have gone down this year or this day, this week, this month, this year. But if you give it enough time, we're talking about like 5 years, 10 years, things will work itself out. All right. Next myth, investing is like gambling. So this is kind of what I was referring to in the past, or just the past slide just now. People who lose a lot of their money thinking that they're investing are actually really gambling, right? And usually when they lose that type of money, they're banking on something happening, right? So I think the best example will probably be like the Tesla group. I don't know how many of you have friends who are so into the Tesla story about like, oh, how it's going to go to the moon or whatever it might be. But that is really a gamble, right? It's not really based off fundamentals per se. It's based off a narrative, a story that of something that will happen in the future. And in Tesla's case, I think for most people, they have been lucky that it has played out the way it did, right? But the way what we are looking to invest, we are not looking to gamble on any specific story or any specific narrative, right? What we are doing here is we're looking to try to make informed decisions based off the information that's available. Of course, we're not going to pure investing, picking out your own stocks or whatever, but doing some basic research that we're actually going to be able to cover this over this course of the workshop is going to actually be a lot of information that you will need to make informed decisions already. All right. And the last myth that we want to cover right now, I need a lot of money to get started. That was also very true in the past, right? Where you actually, especially in Singapore, you had to buy lots of 100, right? So if one single share was costing you $5, then you need $500 to actually start. But now with the advent of fractional shares, robo-advisors, ETFs, index funds, etc., 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 you have a lot of different ways of actually starting without having a lot of money, right? The only thing that we really want to make sure that you do have is an emergency savings fund all set, all right? That said, let's actually talk about why investing is important. Let's skip right to the slide here. If you remember this slide from our first workshop about budgeting, we break down the way you invest, the way you handle your investment money into 3 different categories, right? Those and the things that you need for the next 24 months, things that are 2 to 5 years out, and things that are 5+ years out, all right? And coming back to the slide, the whole point of investing for the things that are 2 to 5 or 5+ years out is to have your money work harder for you so that you are able to actually achieve some of those life goals that you've set out on that budgeting workshop. Okay, now let's actually talk about a very important concept, and it's called compounding. And I think the best way of explaining compounding is to actually give you a little quiz here, or quiz or poll, what have you. Would you rather take $10 million today, or 1 cent today, 2 cents tomorrow, 4 cents the next day, and have it continue to double for the next 31 days? As you can see from the chart here, up to the 20th day, you would have had a total of $10,000. So you had 10 more days. So which one would you take?
Okay, let us know. 1 cent today, doubling each day for 31 days, or just like $10 million straight up? Wow, 90% wants double. Some of you guys want just 10 mil upfront. Well, if only I get 10 mil upfront, I also will be happy, please.
Yeah, let us know in Slido why you think, why you go with certain options here. But yes, I agree. If I got 10 million like upfront, I don't need to be greedy or anything, right? Just take it.
Hypothetical, okay? Hypothetical. Okay, seems like majority of you guys want to double 1 cent for 31 days, but there's still some of you guys who want 10 million. So let's find out if there is a right answer next.
And here is what it looks like for the next 10 and 11 days, right? The 21st day total is 20,000, then 40,000, 80,000, 160,000. Even up to the 28th day, it's only 2.8 million, right? Which is still very far away from 10 million. But if you look at the 30th day itself, you have broken even, right? You made the same amount, 10 million, as the first, as taking that money up front. And more importantly, on the 31st day, you make $10 million just that day itself, right? And that's why compounding is such an important concept. Of course, when we talk about investing, we're not expecting you to double your money every year or anything. But if you have the right rate of return, you can actually have your money double a few times over between now and when you actually are looking to use it or when you're looking to retire. All right. And this is just a quick chart to show you what it actually can look like. So this blue line here, we're looking over a 50-year period. we're talking about 15-minute effort, which we'll definitely be covering today. So between now and in 50 years, you can actually have $1.3 million, right? If you put a bit more effort, 1 hour a month type of thing, you can actually be looking at 1.9 million. And of course, if you're willing to really put a lot of work into learning how to invest, and all of that, and we're talking about 10 hours a month on top of learning maybe initial 1 to 500 hours, you can be looking at having $2.7 million over the 50-year period. But compounding can also work against you, and that's really the concept of inflation, right? So with inflation, you can kind of see here, right? You have a 2%, a 3%, and a 4%. Most governments, they aim for 2%. That is their general goal. So you can automatically assume that your money's losing value over time. But realistically speaking, the last few years, we were looking at closer to 3 or 4%, right? So something for you to be aware of how your money could be losing value. So if we look at what $10,000 today will look like in 20 years time at 2%, we're between 6 to 8,000. So just under 7,000 here. If we're looking at 4%, we're already under 5,000, right? That's 20 years only. And if we're looking at 50 years, 2% inflation, $10,000 today is already under $4,000 of value, right? So as much as you might not be like saving your money, doing things that might be deemed safe and responsible, you're actually losing a lot of your purchasing power over time. That said, and I guess just the best example here is, asking your parents, oh, how much did chicken rice cost? Or, looking at the price of property over time. Even though your dollar today is able to buy a lot less compared to what a dollar in the past was able to do. Okay, so a few other concepts that I want to share with you here. And I guess more realities or things that you should be aware of before you actually start investing. So the first one here is you can't time the market, right? By timing the market, what we mean is you're trying to say, oh, this is the bottom, I need to buy now, or this is the top, I need to sell now, right? It's a fool's errand. And unless this is going to be your full-time job, and you're willing to put thousands and thousands and thousands of hours and work with some of the biggest banks in the world, because that's all they're doing all the time, you probably don't have a chance at timing that market. So what you're much better off doing is just leaving your money in there and having that time in the market, right? So this graph here looks very similar to this graph here. By investing now, just allowing it to ride out over time, and you will slowly have that chart that goes up to the right, which means making a lot of money. Okay. Next, next reality to cover is that it's messier than it's advertised, right? All the graphs that we have shown you up to this point, it's like this nice smooth graph that goes up to the right. But in reality, things happen, right? Shit hits the fan. COVID happens. Trade wars with China and US, what have you, and who knows what's going to happen in the future as well, right? And that's the reason why things go up and down, up and down, up and down. So even if you were to invest today, I can guarantee you that there will be some time in the future that you'll be like, oh, I should have waited a few days longer, or a few weeks, or a few months, or years. But once again, coming back to this whole thing, you can't time that market. So just put it in there and trust that when you start today, you will eventually get to where these graphs eventually show you, right? And because you can't time the market, and because of the ups and downs, never borrow to invest, right? You might think like, oh, if I take out a bit of loans here and there, I can bring up my initial starting point, and then look, I can just ride this whole wave up in this future. But once again, due to the reality of investing and the stock market, your downs are going to be down a lot more. And the last thing you want to do is, be on some sort of loan, some sort of margin, and then have it go down against you and have to pay out all of it, right? And that's really where people end up losing all their money. It's unlikely that they lost all their money because the stock went bankrupt. It is way more likely that they lost all their money because they took on leverage that they shouldn't have taken. which has impacted. And when something like this happens, right, they end up losing their money, and they're of course losing everything, right? And I can say that as someone who has made this exact mistake back in university. So that said, there are two ways to really make money in the stock market, right? The first one is the price appreciation, where you're buying at a lower price and with the goal of selling higher in the future. The second way is to have some sort of dividends, where every few months, every few years, or rather, probably every year, not every few years, but every few months or once a year, the company ends up paying you a small percentage of their returns because they don't because that's the way their business model works. And then you can, have that extra money to then do whatever it is that you like to do with it. The last thing we want to cover before we talk about the investing stuff is making sure you actually have your foundations built out, right? The first thing here is, do you actually have your money for your monthly expenses? If you don't, make sure you take care of yourself first, because all this investing stuff we're talking about is really 2+ years, 5+ years out, right? And if you can't create a healthy lifestyle for yourself now, then having that money in the future is not going to be very helpful when your body's just rotting, right? The next one here is have no debt over 4%. The reason why we say 4% is because with investing, our goal is obviously to make money, but it's going back to this here, it's ups and downs, right? Whereas debt, you are guaranteed to have to pay for. So instead of trying to make more than 4%, it's better off to pay off any debts that are over 4% first, so that you actually, in a sense, are making that extra money back, and in fees that you don't have to pay, and then you can use that money to invest in the future. And the last thing here is, do you actually have 6 months worth of emergency funds, right? A brief reminder here, when we say emergency funds, we're talking about 6 months of your monthly expenses, so that if something were to happen to you, you do have the ability to continue to take care of yourself and not touch your investing money, right? Because the one thing that we really want to avoid is that, let's just say in this case here, went from this high to this low, it might be some sort of recession, it might be some sort of COVID type of situation. And as you might have noticed over the last few years, people have been losing their jobs, right? And the last thing we want to do is have a situation where you might have lost your job because of some sort of overall recession in the economy. And because it's also a recession, your stocks have also gone down, right? So if that happens, you lose your job, the stocks have gone down, and you need to take out your money, then you're selling out at the worst time. Okay. So ultimately, the three things here is to make sure that we are putting you in a situation where you don't have to touch this money for 2, 5, 10 years until you actually need it for your goals. All right. So if you've said yes, that you have all three of these things covered, congratulations. You're ready to actually start investing. Before we actually go into the investing stuff, let's do some quick takeaways here. First one here, compounding is what makes investing such a powerful, powerful concept. That is the way you get that graph that goes up to the right, right? And the next one here, the most important thing about compounding is the amount of time you give it. Want to just emphasize here, in 20 years, everything looks the same. 30 years, still not much happening. 40 years, you're starting to see it go up a lot higher, from 700,000 to, or 400,000 to 760. But from 40 to 50 years, that's almost when your money doubled, right? And that is why it's very important to give time to your goals and let compounding work for you. And of course, compounding or inflation is compounding working against you. Next one here, invest the money that you don't need for your daily expenses, and then make sure you have 6 months worth of emergency savings. Pay off any debt over 4%, since that's a guaranteed type of return for yourself. And time in the market is way more important than timing the market. And we can only expect returns to be a certain way, but in reality, it's a lot messier, as shown here. That said, let's answer some questions.
Okay, first Q&A. If you guys have any more questions, please send them in and we will try to get to them. Okay, we have one. Should we answer Lynn's question now or should we do it later? Because Lynn, we're going to touch on ETFs later actually. Okay, we can answer it now. What's the difference between index fund and ETFs? CS?
I was muted. So no, I just wanted to acknowledge, Lynn, that we have seen your question, and it's actually one of the topics that we'll be going into a little bit deeper. So I think it'll be a lot easier to answer any further questions you might have about that after that section.
Okay, yeah, Lynn, if whatever we cover later doesn't answer your question, you can feel free to send them in. We'll have multiple Q&A sessions, I think two or three more during this entire session. Okay, Joanne asks, what does having no debt over 4% mean? Does it apply to property loans?
Yeah, so I think it's going to be really up to you what you're comfortable with. So the idea here is when it comes to, like I mentioned in the video, when it comes to having debt, you are guaranteed to have to pay those interest rates. But when it comes to investing, there is no guarantee that you get certain investment returns, right? And that's why the idea was if you have debt that you feel is still too high, and usually, in my case here, I use 4% as the benchmark, then it might make more sense to actually pay that off as opposed to trying to put your money into something and then not getting the same type of return. So it's really up to you what makes most sense for you. When it comes to your property loan here, I would say I think property's a bit different. I don't want to get too deep into the weeds, but the way the way property typically works is you can almost refinance your debt for as long as you want. And I guess because your debt is tied to a property, which is technically also an asset, then it can kind of work itself out, or potentially work itself out, right? So from that perspective, it's not as big of an issue. When we created that specific 4% rule, is really more like student loans or credit card bills, especially credit card bills when you're talking about 20% or so. Like that's a very, very, very tough number to beat in the stock market or in any sort of investing. So paying off those types of bills makes a lot more sense.
I think that leads us to the next question by Sam, which is how did we come up with the 4% interest?
Yeah, so this is really, once again, it's just something that so this initial idea came up before COVID, right? And at that point, most interest rates were close to zero, which is why anything above 4% was actually it's considered like high end debt. But now that the average debt is closer to 4%, I can say that if you feel like it's not, your debt's kind of an average thing and it's not that big of a deal per se, and you feel like you have a different way to use your money, that's completely up to you.
Okay, and we have one from Vanessa. What's the best way to grow my money as I need quite a bunch for life expenses this year? Oh, this year is pretty soon, Vanessa.
Yeah, so I wouldn't say you'll be looking to invest anymore for any sort of like quick money per se. I think and this goes to anyone, not just like, someone who needs money for life expenses or what have you. Finding ways to increase your income is probably going to be the most effective way to grow your total disposable income, right? So whether that's getting a promotion, whether that's doing some freelancing work, whether that's like taking on a client outside of your full-time job to do some sort of freelancing work, I think those are probably going to make a much bigger dent into your income than investing would especially if we're talking about in the next year, 2, 3 years.
Okay, and from Dorothea, is there a percentage ratio to how we should split our investment money for the three different categories of goals that we talked about?
So I would say, realistically speaking, your less than 2 year stuff is almost like if it's actually a very important goal for you, there is no way to like you essentially need to put as much of that money into making sure you hit those goals, right? When we created the budget tracker, one of the things that we got you to do was write down what your goals were for the next 2 years. And then based off that, we also got you to figure out how much money do you actually need to put aside every single month in order to hit those 2 year goals, right? So that number, the under 2 year goals, it kind of can pretty much come from there. And after that, it's really just a question of, okay, what are your 2 to 5 year goals and what are your 5+ year goals? When it comes to 5+ years, I think the biggest one is most likely retirement. And we do have a calculator underneath this the screen that you're on, where it kind of helps you figure out how much you actually need to put away to hit the income goals that you're looking for at retirement. So I think that can kind of give you a rough idea in terms of what you should be looking for. Of course, one thing to always remember is that a lot of these examples that we're using here are all assuming that your income's not going to grow anymore, right? But I think a lot of us here, probably still very early on in our careers, our income should continue to go up at least 50%, if not double or triple where we are right now. And that disposable income can play a much larger role in helping you achieve some of your longer term objectives. So I would say primarily focus on your goals for the next 2 years and then focus on the next 2 to 5 years. And if you have the capacity to start putting away money for the 5+ years, then do so then.
Okay, I think we'll carry on with the video for now, and we'll answer the rest of your questions in the next Q&A.
All right, let's press this button. Wrong button. Let's press this one here. Okay, sorry guys, it looks like it's not actually working. Let me just quickly pull up on my screen here. Okay, so now that we've covered some of the more fundamental psychological things when it comes to investing, the rest of this session is really going to be covering more of the technical aspects of how do you actually invest, what are your options, and all that good stuff. All right, so that said, we have 4 other things that we are going to be covering today. We are going to be talking more about your different investing options and how you can potentially automate your investing in 15 minutes, right here. We also will be talking more about how you can split your investing, what's a proper way of looking at balancing your investments, making sure that not all your eggs are in one basket per se. We'll talk more about passive investing and how exactly that works. And of course, we'll be covering a lot of these things that are going to be related to robo-advisors. All right, so next slide here. We want to be investing based on our goals, right? So I believe we've talked about this a few times throughout the workshops already, right? In the sense of we can't look at all of your investments as the exact same thing or trying to achieve the exact same thing, right? Because some of your investments are really meant for things like in a year, next year or two. Some of the things that you're looking to do in the, maybe 5-10 years time is, have kids, get married, buy a house, et cetera, et cetera, et cetera. And of course, the big, long term goal is to be able to not have to work and still be able to have a good life, i.e. retire, right? So because we have all these different goals, the way we have to approach our investing is also very different for each one. So in the past, we have already talked about, but if you need your money in the next 1 or 2 years, you really want pretty much no risk, right? If last thing you want is to, let's say, have all your money invested for some sort of like goal of buying a property, and back in 2020, right? And you had all your money invested, with the hopes of it going to be doing really well. And next thing you know, the pandemic hits, and all of a sudden, all your investments have lost a lot, right? So those are things that we really want to minimize the chances of, which is why in the next 1 year or 2 years, we really want zero risks almost, right? Once we're looking at like a little further out, 2 to 5 years, we can kind of have more risks, right? Going back to this example of COVID, COVID, the whole thing lasted, or it's still going on per se, but from a more financial investment type of perspective, that whole saga lasted a year and a half, 2 years, right? So if you were to have invested back in 2019 for something that's 5 years out, fast forward to today in 2023, or sorry, 2020, or beginning of 2024 now, your investments are pretty much at par if you had bought like some of the fundamentals, right? And I'll show you more of those examples later. So yes, some risk is you're able to take on some more risks, but of course you don't want to be too crazy, right? And of course, once you're now talking about things 5 years out, 10 years out, things like retirement, this is when you really want to be as aggressive as possible, because you have the most time to have the way the markets work itself out, right? So one thing you might be also wondering is, what if you have a goal for, let's go back to the whole 2019 example. You had a goal for 5 years time where you want to buy a property or something, right? You're moving into your BTO. So in that case, for the next 3 years, from 2019 to 2022, you would have had your money invested in something that a bit more risky. But then once it comes to you're 2 years out, so let's say and the goal is to have it by the end of 2024, then by beginning of 2023, which is already kind of 2 years out, you pretty much want to start moving all your investments from where you initially had it to something a bit more safer, right? So there's actually a bunch of other things, or rather a bunch of things that you need to know about investing. However, given the scope of today's workshop, we will only be able to cover maybe 4 of these, right? And introduce you to 4 of them. And some of them will be able to go a lot deeper, and some of them will just lightly touch on, so you have an idea as to what is out there. Okay, so what does that mean? We will primarily be covering the types of investment vehicles, primarily robo-advisors, and how passive investing actually works, right? And 3 main topics that we'll be kind of covering today under these 2 is a 15-minute plan that automates all investing and maybe gets you 4 to 7%, a way to make a bit of extra money on your emergency saving funds and maybe your goals for the next 1 or 2 years. And then at the end, we'll briefly talk more about how you can maybe spend an hour an hour a month type of thing, and be able to get 5 to 8%. Let's first talk about the 15-minute effort. And in order to actually do this, we are going to use something called robo-advisors. I'm sure you've all heard of robo-advisors by now, but what exactly are they? And how are they actually a 15-minute solution? Taking out all the technicalities, what it actually is able to allow you to do is you're able to tell it exactly what you want to invest in, how much you actually want to invest each month, and it can actually take it out of your bank account and do it for you, right? And that's really the key as to why it's a 15-minute solution. You are able to kind of go through the whole onboarding process with these robo-advisors. It'll tell you what it suggests. You can make some changes if you'd like. And then from there, you just say, now every month, take out $500 from my bank account and invest it in this thing, right? And because of that, you're now done. You don't have to ever think about it ever again. So if it's such a good deal per se, what are some of the things that you should be aware of? First of all, when we talk about robo-advisors, let's just use Stashaway and Endowus, Syfe. I think those are probably the 3 largest ones in Singapore. There's a few other things that you need to be aware of, right? So let's just use Endowus for an example. Even though Endowus is a robo-advisor, they have maybe 24 different things that they can invest in and for you to choose. And because of that, going back to our conversation earlier about having to make sure that you have different ways of investing for different goals, you will also need to invest differently for each of your the things that Endowus offers would also fit differently, right? So things to consider when you before you invest. What exactly are you investing for, and how far out is it, right? So we already talked a lot more about that earlier. What are those products that actually fit my needs? So now that let's say you're looking for a goal for investing for a goal for 2 to 5 years out, what exactly should you be looking at investing within the robo-advisor and Endowus space, right? And then from there, let's say Endowus has maybe of the 24 products, they have 10 products that kind of fit the 2 to 5 year mark, right? So of those 10 products, what are those actual past returns actually like, so that you have a rough idea as to what it's been able to do. Of course, past return, not guaranteeing future value, blah, 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 blah. However, if the fact that they've gone through a COVID type of scenario and like how actually has it fared, can give you a lot of insights in terms of how well it's actually being managed, or the way it's actually managed, right? And then after that, what exactly are the fees associated with these robo-advisors, right? They're not doing this for you for free. They need to actually make a living themselves. So how much do you have to be paying in order to get their services? And then how many accounts do you actually want to have with, in this case, with all these different robo-advisors? So in this case, Endowus, right? You do have the ability to have multiple accounts. And from there, you're able to do different things, right? So we'll kind of cover a bit more here and there. So let's kind of continue here. A bunch of things that we talked about on this page here, what products actually fit your needs, what are some of the past returns, and all of that. We have actually created our robo-advisor guide here, right? So I'm going to show you, since this is a recording, I can actually do this here. Let me just change my screen to this one, right? So kind of going back to what we were talking about, what fits your needs. So let's say you're looking for things 2 to 5 years out, right? So we click here, we can see all the 2 to 5 year products here. And now we can then quickly have a rough idea in terms of what we consider what type of returns have they been. So let's say the last 2 to 5 years, we can look at the 3 years and the 5 years to see how they've done. And then from there, you can kind of have a short list, right, of things that you can consider and play around with. All right, so that's all I want to show you here at this point. So this guide will be available to you after the workshop. So do take some time to play with it and see what all your options can look like. All right. So in regards to this slide here, everything we show here are all historical data, right? We don't actually know how it will do in the future. Past performance is not guaranteeing any sort of future returns or anything like that. But ideally, it should kind of rhyme with what it has been able to do in the past, right? So make sure you actually look at your options yourself. Make sure you fully understand your own situation, and then from there, make your own informed decisions. All right. That said, let's look at some generic advice that we have for as a starting place that you can use, right? So when it comes to savings, your emergency savings and all of that, we actually suggest the Syfe RoboAdvisor, and within the Syfe RoboAdvisor, they have something called a Cash Plus account, right? And the reason why we suggest that is primarily because your money can be withdrawn within a 24-hour period, right? Especially when it comes to emergency savings, the whole point is that you need access to that money in a very quick turnaround type of period, right? And with Syfe Cash, this is the quickest you can get, 24 hours, right? Besides that, Syfe is at this point of this recording, their Syfe Cash gives you about 3.8%. That is not a guaranteed amount, which is the con here, like we mentioned here. And I also, in order to get you the 3.8%, there are no terms and conditions that you have to jump through, right? Unlike some other banks or some other savings accounts or savings alternatives, right? The biggest con here, or the two major cons that you should be aware of: number one, not guaranteed. This is just a projected rate of 3.8%, and they have the ability to actually project it out. But if something were to drastic were to happen, like let's say a COVID, that return might not actually come out, and you might actually end up being negative. So it's something to be aware of, and it's not insured like a bank, right? So if something were to technically happen to Scythe, you are not promised to get back your money, right? That said, that's a more of a legality thing. You probably will end up getting back all of your most or all of your money, but that might take a few decades or something, right? But I mean, Scythe is a relatively large company, and I don't foresee it suddenly disappearing, right? Moving on. If you have your 1 to 2 year type of goal, so once again, if you remember back on our initial slide, it's really something that you almost want virtually zero risk. With Scythe, they actually have some pretty good returns for things that are guaranteed, right? So unlike this first one here, where this is not guaranteed, this one that we're talking about, this specific product, I think it's called like Cash Plus Guaranteed or something, actually guarantees your rates, right? And the guarantee amounts are shown here. So one thing to be aware of is that a lot of these companies like to talk, give some sort of big number like 3.8% or something like that for 3 months, or what in this case, 3 months. But the 3.8% is over if you were to actually be invested over a 12-month period, right? So that said, with 3 months, if you were to put away, let's say, I think you said $1,000 here, you can expect to make $9.50, right? But if you left it in there for a 6-month product, you get slightly less, 3.6%, but of course your overall amount is $18. And if you invest it for 1 year, you get even less at 3.5%, but of course you actually get the full 3.5% or $35 here, right? So one question you might be having is, hey, since it's a 3 month, it's 3.8%. At the end of 3 months, can I just take this whole thing and invest it in another 3 months and get 3.8%? The answer is yes. You can take out your you'll get, once the 3 months is over, you'll get all your money back, and you can take all that money and invest in a 3-month product, right? The thing, though, to be aware of is that it is not guaranteed to be 3.8% at that point, right? Who knows? Maybe tomorrow, or by the time we actually publish this workshop and you are actually watching it, maybe it's not 3.8% anymore, right? So this is kind of what you consider like locking in, right? If you think this is a good rate, you want to lock it in right now. So in this case, if maybe it makes more sense for 3.5%, right? So yes, so now that we, in workshop number 1, where we talked more about creating a roadmap, kind of having ideas of where your goals are and how far out they are, then you can actually start using that to project it out, right? So if you had a goal that's 4 months out, then you can actually invest your money in this 3-month thing and have it out by that 4th month, so that you can actually use that money, right? And be able to get a bit more out of your cash, right? Okay, so now we are going to look at using Scythe when it comes to investing. So this is your 2 to 5 years. This is your 5+ years, right? 2 main things we want you to be aware of. Number 1, they do have some of the highest returns with an asterisk that we'll talk about. And Scythe as a platform has some of the lowest fees as well. Now that we've covered the fees, let's actually talk more about the returns. Why is there an asterisk here? So this is our robo-advisor guide, right? And here we have highlighted Scythe Equity 100, which is their product, has returned on an annualized basis over 10%, right? Or just over 10%, which is much high, or not much higher, but higher than everyone else here, right? What the only caveat is, when Scythe first came into the market in Singapore, they were not actually offering this, right? They were offering something else. And it was only maybe 2-3 years ago that they changed from offering whatever they initially offered to this new product, right? So that is something to be aware of. This product is proven to have had the best returns, but Scythe as a company had changed their decision or changed their product offerings, right? And so we don't know if they might change in the future, right? And that's the one thing, I'm not trying to scare you or anything. I just want to make sure you are aware. There is no reason for them to change it if it's actually working, right? So yeah, just something for you to be aware of. Okay, moving on. Let's talk about Endowus, right? I think in the way I look at Endowus is that they are by far the best option when it comes to investing your CPF and your SRS money, right? Number one, because, and I guess the main thing there is, number one, they are the ones who started as a company offering this, so as their main service, right? So they do have the most experience working with, CPF and all of that. And number two, they offer the lowest rate at a flat 0.4%, which is quite a bit lower than, or not quite a bit, but most other places start at like, somewhere between 0.6 to 0.8%. So you are getting more bang for your buck per se by investing your money, your CPF money with Endowus. All right. And I guess a few things to talk about investing your CPF money. First one, when it comes to your OA account, I would actually suggest that, this is up to you, right? What do you need to do? What do you have coming up in your life that you can use your OA money for, right? If you have a mortgage or something and you can use your OA money to pay for that, then I think that's a way more valuable thing to use your money for, because ultimately with CPF money, the whole point is to have it, saved up for when you retire, right? However, of course, like if you're planning to have, just got a property, you're having kids, all of a sudden your expenses start ramping up a lot faster. And if you can't make ends meet with just the leftover cash, then I suggest you use your CPF money to pay for your mortgage, and then use that money you would have had to that cash that you would have had to use for paying your mortgage to pay for other things, right? So indirectly using CPF as a way to fund your life. However, if you are only looking at investing or the rest of your money for CPF is really meant for retirement, then I highly, highly, highly suggest you invest that money, right? So one thing to be aware of is that your SA is giving you a guaranteed amount of 4%, right? Which sounds pretty nice, but in reality, if you are looking to invest, 10 plus years out for retirement, going back to this example here, you should be very aggressive. And all these aggressive ones, if you look at, have all done better than 4%, right? So that is something I would highly suggest you consider. Okay. And yeah, of course, SRS, and you should definitely be investing that money as well. All right. So let's move on. A bit more about Endowus. Their investment returns are not based off what ifs like SIFE. They have been around. They have continued to have the same portfolio for the longest of times now, and their returns have also been some of the highest over this whole period, right? So in a sense, I guess the way they have invested, it seems to suggest that they really know what they're doing here. Another thing about Endowus, if you're looking for it to put your emergency savings, I haven't been able to find some sort of guaranteed cash return like SIFE, which is also something to be aware of. And when it comes to general fees for investing your cash, they have the lowest ones at 0.6%. Next, we have Stashaway. I was actually very surprised when we were putting together all the latest research. Stashaway seems as a whole to have underperformed both SIFE and Endowus by a significant amount. So it's really hard for us to suggest anything of theirs. They also have the highest fees, which doesn't help their cause. That said, Stashaway does have a guaranteed product similar to Endowus. Sorry, not Endowus, similar to SIFE. But what they have also offered is a 1 month guarantee, right? And 1 month guarantee at 3.6%. So if you remember back with when we showed SIFE Syfe did not have a 1 month guarantee. It started at 3 months. So here, if you wanted to invest your, fully invest all your money at all times, and you can then use Stashaway to invest your 1 month emergency savings or 1 month goals type of things. Okay. With banks or with robo-advisors, their whole goal, because they don't have a pre-existing relationship with you, their whole goal is to have to perform with merits, right? Really focus on making sure you get the best returns, the lowest fees, best user experience. So it's super easy to get started and all that, right? With banks, however, they do have pre-existing relationships with you. And as a business, they are trying to take advantage of that, right? Of, you already have a bank account with them, might as well just invest with them and use their robo-advisors, it's just a click away, which, it's fair. It's better than not doing anything. But when we're actually competing with robo-advisors, they don't have to be as aggressive with their R&D, making sure that they offer you the best experience. And they probably can charge you more because you already have an account with them, right? So yeah, I mean, that's just the reality of how banking products tend to be versus if you were to find your own solution. Of course, the cost of finding your own solution and having the fact that the bank already has all your information, you don't have to do much more. There is value there. It's just how much are you willing to assign in terms of fees to get that value, right? Okay, so we covered all the major robo-advisors. So question for you on Slido, which robo-advisors do you already have accounts with?
I'm back. Let us know if you already are using robo-advisors, which do you have accounts with, or do you have all, or just one? Let us know. I do have Stash. Oh, I only haven't used Syfe. I have both Stashaway and Endowus.
Yeah, I
I
think
mean, there are
Stashaway
other, there are others lah, but yeah, these are the three main ones, right?
yeah, Stashaway I think was the first entrant into the robo-advisor space. So I think most
Yeah,
people probably started off with Stashaway.
yeah. I started with Stashaway and I moved to Endowus. Yeah, but I still have an account with Stashaway lah. Yeah, let us know. And just to let you guys know, we are compiling all of your questions. I think we have one or two more Q&A, so we'll try to cover all of them.
Siphon and Dallas, Stashaway, AutoWealth. Yeah, I haven't looked too much into AutoWealth yet, but we'll definitely do that and add that into the robo-advisor guide that you guys will get.
And also let us know in the chat, like, are you happy with the robo-advisors that you're using right now, with like how they're handling your money or the user experience or the returns, whatever. Let us know if you guys are happy with the ones that you're using. Yeah,
All right.
wow, Stashaway and Syfe are the main competitors, I guess.
Good to see. Shall we move on? We have a bit more to cover, and then I think we'll be hitting a Q&A soon. So
Okay, yeah, let's continue with the video.
All right, so we've gotten a lot of these questions throughout the whole workshop and on a regular basis, and we've mentioned that we'll talk about it during the investment workshop, right? So here we are. Why do we not like ILPs? I think you can pretty much think of ILPs similar to a robo-advisor, right? You're paying a certain amount of money in regularly. In ILP's case, you're forced to, right? And then the robo-advisor or the ILP will invest that money for you, right? However, the biggest difference between a robo-advisor and an ILP is that the fees that ILPs charge are ridiculously high, right? And so much so that I am willing to publicly make a bet with anyone, up to $1,000, that a robo-advisor's return would outperform ILP's return in the next 10 years, right? So that is kind of how I look at it. And it's not necessarily that it's gonna outperform because the products are going to outperform, but it's more the all the fees. After you take out all the fees, that product or the robo-advisor will do way better than the ILP. All right. Okay, so what exactly are the fees that we're talking about? These numbers are, of course, not conducive of every single ILP that's out there. Every single ILP has a different structure, and the different structures have different types of fees or are worded differently, what have you. So and that just makes everything that much more complicated to understand. But in general, an ILP, there are almost 4 types of fees, right? There's some sort of administrative fee, and this is kind of almost like the fees that that whatever the ILPs invest in charge the ILPs, and then they charge it back to you. There's some sort of supplementary fee. Honestly, I don't even know what this means. And then within the ILP itself, they might have some sort of sales fee, so some sort of upfront fee. Whenever you put in your money into an ILP, they might take a percentage of it as fees. And then there's also of course, the management fee that an ILP will charge for, making the decisions it does for you, right? So all that said, it's just way, 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 way too high. When we were talking about robo-advisors, we were talking about 0.6% being the high end, or 0.8% being the high end, right? And in this case here, nothing here pretty much even is close to that 0.8%, 0.6%. So that leads to the question of, why did ILPs even exist in the first place, right? And the thing is, with ILPs, you have to kind of look back in history. ILPs really began becoming popular in the 90s when your investing options were very, very, very limited, right? There was no such thing as using an internet to surf and get information. There's no such thing, let alone having some sort of stockbroker or robo-advisor to do things for you. Everything was a lot more manual. And yeah, at that point, it justified the fees, right? It's either you invested with an ILP or an equivalent like mutual fund or something, or you don't invest anything at all, which is not the right decision for a lot of people, right? Back then, it made a lot of sense. They had a lot of people that was required to actually make an ILP work for you as an investment, and all those people needed to get paid. So yeah. And with ETFs and robo-advisors, and later robo-advisors, those things only showed up once the internet started taking shape, right? Where it was a lot easier to show people what was possible, actually automate a lot of things, make it more passive. And then robo-advisors took that to the next level where you can actually now automate the whole thing, right? So that said, I believe the ILPs had a purpose back in the days. However, given the reality of where we are as a society today, with the technology that's available and all the different options, ILPs are just flat out inferior to any sort of investing that you can do. Next, let's look at endowments and how it does versus SSB and robo-advisors. As a whole, even though, normally when we talk about robo-advisors on SAV, we are not a fan, and we'll talk more about why later. But there are very specific situations where robo-advisors might be actually a very good deal, right? So for example, FWD offered a Save First Series 2, and it was like a limited offer type of thing, right? And it guaranteed a 4.5% a year for 2 years. That is actually really good compared to your other options, right? Especially since when we initially talk about your 0 to 2 years type of goals, we wanted virtually zero risk, right? And when we talked about them, using, let's say, or SIFE as an example again, the best you would have gotten if you want to put out for 1 year is 3.5%. So 4.8% is much higher than 3.5, and you can actually get for 2 years as opposed to 1, right? Which is why an endowment, like these special endowment products, when they come up, could be a really good option when you have a 2 to 3 year goal and you want some sort of guarantee, right? But of course, keep in mind that when you do invest in endowments, they are locked in unlike a robo-advisor where you do have the ability to take the money in and out and do things with it, right? So make sure you do have some wiggle room if something were to happen and all of that good stuff, okay? Or not good stuff, but like bad stuff, I guess. And of course, if we're talking about the more typical endowments, 5, 10, 20 year type of things, you really need to start comparing those options versus your other alternatives that you have for 5, 10, 20 years out. All right. And I mean, this is just a quick example here. Let's say you were looking at something, endowment that was given, that had a 10-year maturity. What are your options for 10 years out, right? And even if you were to stay more conservative, so in this case, like Endow is conservative or Scythe conservative or Stashaway's, I guess Stashaway, we don't really know how they've done at 10 years out. But the first two here, each of them were able to give you about over 3% return each year for 10 years, right? So take that and look at that and compare versus your the endowment that you're looking at. After 10 years, how much are you actually getting, and what does that actually break out to on a year basis? So we covered quite a bit already, but let's quickly do a quick summary here. If you're looking for things for under 2 years, our suggestion is to go with Scythe or Stashaway for those guaranteed returns, just because we really don't want to risk having our money disappear when we need it, right? Next, Endowus is great for investing your CPF money, and also could be one of the best contenders for investing your day-to-day cash as well. Bank robo-advisors cannot compete with pure robo-advisors. We've talked about that already. And ILPs and endowments are no longer competitive. Caveat there is an endowment offering some sort of very specific special. All right. That said, let's answer some of those questions. And how we're going to get a higher return.
Oh, my face became so big. Okay. Q&A time, guys. Okay, let me look through some of the questions y'all have and we'll answer them. Okay, one on emergency funds from, did we not answer that?
From Bell?
Yes.
No, we have not. Okay.
Okay,
so
6 months of emergency savings. Would it be 6 months of savings, the 10% that we went through in our budgeting workshop, or 6 months of income?
I personally would suggest 6 months of your actual day-to-day expenses. So that could include rent or mortgage. It can include any other bills, subscriptions that are required to be paid for, insurance and what have you. So those would be the ones that I would say are essentially the non-negotiables that you will have to continue to pay with, even if you have or do not have money. So 6 months worth of that.
Also, Belle, if you remember our 41212 rule, there is a 10% for savings, and then there's another percentage for investing, right? So what we're trying to say here is that if you haven't built up your emergency savings, all of those money should go into your emergency savings first every month until you've built up 6 months of your expenses. After that, when you have 6 months of your expenses saved up, then these amounts can be put into investing. Yeah. So I hope that's clearer. Yeah. Okay. Gary has a really long question on DCA. So he says, DCA is a popular strategy. Any idea on how to improve on top of it? Some suggest to increase the amount during market downturn, but that will require to keep more dry powder uninvested. What do you think of this strategy? Any pros and cons?
Yeah, Gary. So we talked earlier in the, like closer to the beginning, we mentioned don't try timing the market, right? And it's way more important to just have as much time in the market as possible, because the last thing you want is, you have all this dry powder uninvested, and then the market just kind of goes up, right? And then you feel like, oh, are you going to FOMO in? Are you going to continue to wait and what have you. And there's just that initial, or that there's always going to be that question of like, what should I be doing? What should I not be doing? My suggestion instead, if you wanted to find ways to increase your ability to invest during what you consider like a dip or a downtime and what have you, I would suggest you go with reevaluating what your goals are. Um, so let's say, for example, you have a goal next year to go do like a pretty massive Europe trip, right? And you're right now budgeting $10,000 to make that happen. Is that trip something that you want? Do you prioritize that trip, or are you willing to push that trip out a year and in return use that $10,000 to put into the this opportunity that you see, right? So I guess the way I would look at it more is reevaluate your goals and see which ones you're willing to give up or push away in return for putting this into the market if that is what you wish to do. I would not suggest leaving money on the side unaccounted for.
Okay, please pick the next question, CS, while I answer a question on Slido itself.
Okay. Let's see here. Natalie, I think we've covered a bunch of different robo-advisors and my personal thoughts on them. So if you have any other questions about that, more than happy to answer that. Joseph, how do you determine the level of risk carried with each ticker and stock? I think that's going to be a much more complicated question than what this workshop is going to be about. At this point, you're essentially looking into the business, right? What exactly are the risks associated with the business? I think one of the best examples right now is, how much exposure does the business have to China or to the Middle East, where there's more conflicts and what have you. So, for example, yeah, I mean, I don't have any really good examples off the top of my head. All I can remember is like when the war with Russia first began, there was a lot more companies, or the government, U.S. government took some pretty serious actions, and a lot of companies were trying to pull out as fast as possible because their business in Russia was just destroyed, right? And one can also argue the same thing's happening with China. So those are all things that I would say you're looking more at a business level than as opposed to a particular ticker or stock or what have you. Okay. Joy, do you have one question for me, or should I continue down this list here?
Yes, okay. Dorothea asks, why would I want multiple accounts with one robo-advisor? Or by multiple accounts, do you mean holding different products or buying into different products under one robo-advisor?
So, I guess you would still have one login, and you might have multiple portfolios, right? And each portfolio could be holding something different. So the reason you would do that is because you want to make it very clear that some of the money that you're investing is for one particular purpose, so that it's not a mismatch of everything, right? So I guess the best example is if, let's say you're using Syfe, then you would probably want, and you're only using Syfe and you only want to stay with using Syfe, then you might want to have 3 different portfolios. One would be for your 0 to 2 year goals, one for your 2 to 5 year goals, and then one for your 5+ year goals. So that's really what we meant by having multiple accounts.
Okay, pick the next question.
Okay, so final question, and then we'll go on a quick break, toilet break. So Gary asked, what would you recommend your portfolio composition? 60% equities and 40% bonds? I would say that's highly dependent on you. Assuming most of us here are in our 20s, 30s, I would say anything that's 5-year retirement stuff should be almost 100% equities because you have so much time. Versus, I would say maybe 60% equities, 40% bonds might be a better fit for something that's like closer to a 2 to 5 year type of period. Yeah, so that's all I'm gonna say about that. I think there will be sorry. So before I continue, Joy, anything else you want to add before we give them a quick 5-minute break?
No, you are all allowed to go to the toilet.
Okay, so in 5 minutes, so 9:22, and then we will begin. In the meantime, I will um, kind of take Gary your question a bit further. I mean, it's all recorded and what have you. So anyone who needs to take a quick tea break, please do so. Let me just go to the site here. So let me share my screen. How do I share? Here it is. Okay, so going back to your 60/40, I think a lot of robo-advisors have products similar to that, right? So we're probably looking for something the 2 to 5 year mark. So this is probably closer to your 60/40 as a whole, right? Something that I'll be adding on in the future for you to have more access to. Sorry, just want to make sure everyone's on the same page. This is the robo-advisor guide that you'll be getting after this workshop. And I'm just showing you some of the features that is in here for you to have a better understanding as to how you can actually use it. Okay, so 2 to 5 years probably are the things that you're looking for. That's closer to a 60/40. And then you can kind of see how do they actually do over the last 3, 5, 10 years. Okay, so considering you're looking for 2 to 5 years, you're probably really just paying more attention to the 5 year performances and the 3 year performances. So I would suggest, you use something like this to kind of have a better gauge in terms of how to approach your investment or portfolio construction. Okay. Whoops, hold on. Was I not sharing my screen? Joey, you're
Yes,
so
now you're
silly.
sharing it.
Yeah, sorry. So this is the ultimate robo-advisor guide that you'll be getting. On here, you have a tab that has all the robo-advisors and their different investment options. I was showing what I was talking about was the 2 to 5 year stuff, which is your 60/40 portfolio. And from there, you probably want to look more at the 3 years and the 5 years to kind of see roughly what type of returns you could potentially expect if you were to invest in that type of portfolio. Okay. Something else that we have created is, so the retirement calculator is here as well for you to have one place to actually see how much you need to actually invest. If you haven't played with it already, just scroll down on your screen right now, type in your age, your desired retirement and income and all that, and see how much you actually need to start saving each month, start investing each month to get that to get to whatever that ideal income is. Okay. And the last thing I just want to quickly show is this page here, Test My Portfolio. Essentially, it will allow you to pick up to 3 different investment products that robo-advisors have. So I don't know, I'm just going to choose a random one from Syfe. Let's say the Syfe 100. I'll choose a random one from Stashaway. Let's say Stashaway Balance. And I'll choose a random one from Dawes. Let's say let's choose something a bit different. Technology, right? So I have chosen my 3 things, and then I can say like, oh, what if I want to put, let's say, if my monthly investment is going to be $600. Let's say I want to put like $300 into this here, I want to put $200 into this one, and then $100 here. And then click this button, and it will actually show you what the returns would have looked like from 2014 to 2020, essentially to today, right? So in this case, this portfolio that I just made up off, during this moment here, returned 72% over that 10-year period, and I made about $4,000 in profit. And you can kind of see each year like what exactly happened to the Syfe equity, to the Stashaway, and the technology stuff here. So this is also a good way for you to start exploring what it could look like to create your own portfolio. And we're only using information that they provided us from 2014 to 2023. So all of this is past information. So yeah, we're not projecting what's going to happen in the future with this thing here. I'm going to stop there. And Joy, any thoughts when you initially saw this guide? Anything else you want to share with them?
No, I guess try it out, and if you have any feedback for us, please let us know. If you haven't like explored a lot of different products in these robo-advisors, or you want to compare between different products or between different products of different robo-advisors, I think this is a pretty good tool to help you do that. So just play around with it and adjust the investment, and you can see the numbers.
Yeah. And we'll be continuously updating this with other robo-advisors that are out there. So if there's something that you want us to add, just message us on SAV Club, and we'll add that. And if there's other things you want to know about robo-advisors that you feel like would be a good fit into this guide, also let us know, and we'll see how we can add that in.
Yeah, and also let us know if a tool like that if you think it's useful. Let us know as well, and also what other tools you want to see. Maybe CS can create them.
Yeah. All right, I think it's time to get back to it, shall we?
All right.
ETFs, right? ETF here stands for exchange traded fund, but the more layman term is, think of it almost like a Spotify curated playlist. Let's say you don't know what your type of music you're looking for, or who the artists are, what the best singles or whatever are. But you really like a certain type of music, right? So for me, let's use my example like jazz, right? And what I can do here, and what you could do, is you can then go to Spotify, look at a playlist, and just click on a button, and it will then start playing all the different types of music that is part of that playlist, right? And similarly, an ETF would combine all the different stocks or assets that fit in that theme. So let's say the theme for is that you want to invest in Singapore's largest companies. You can then buy an ETF that does exactly that and give you access to all of Singapore's largest companies. Okay, so this is going to be the most technical we're going to get today in this workshop, and that is understanding what exactly an index is. So what exactly is an index? Think of an index like an indicator. In this example, the cost of food, the cost of rent, transportation, housing, et cetera. And it gives you a high-level overview as to what is happening, right? And in that specific theme. And in this case, we're talking about the cost of living, right? Similar to cost of living, there's like a Straits Time index, which covers the 30 largest companies listed on Singapore. And then there's the S&P 500, the most infamous one here, and tracks roughly the 500 largest companies in the US, right? But of course, an index is simply similar to what we showed here, the cost of living, or CPI or something. It's just a number, right? You can't technically buy or invest in the Straits Time index or the S&P 500 index, right? Because you're putting your money into a number, which makes no sense, right? So what ETFs then do is they go and mimic exactly what this index was, right? So in this example of what we used here, index simply a number that says how Singapore's top 30 companies are doing. You can't actually buy it, but they do mimic the index by buying the companies inside the index. So now you can buy into that index yourself, right? Yeah, that's really it. I mean, so it is important to understand that an index is usually some sort of final number that kind of gives you a sense as to how well or how something is doing. In this case, the cost of living. It could also be inflation, technically is an index, right? The Straits Time, of course, we talked about the S&P. And the ETF then allows you to buy into these other indices, right? So the S&P, the Straits Time, and then other index. There's a lot of different indices that exist out there. So let's use one final example, and let's use an index of Joy's investments, right? So let's say Joey created her all-nighter index, right? And this, her, if you don't know about something about Joey, she tends to be a night owl. I don't know what time her average sleeping is. We can ask her later live. But let's just say as part of Joey's all-nighter, she's using Apple products all the time. She's listening to Spotify. She's using Adobe to do her designs. You might be using Netflix to just take a break. Use PayPal to make some payments. Starbucks, to keep up all night, and probably late night munchies with McDonald's, right? So all of these things are things that Joey would go under Joey's all-nighter index. You could technically go and mimic it yourself by buying a share of Apple, a share of Spotify, Adobe, et cetera, et cetera, et cetera, et cetera. Or you could just buy the ETF, ZZZ, ZZZ, whatever you guys like to pronounce it, right? Yeah, that's ultimately what index is here for, right? Or an ETF is here for. It helps you simplify it helps you get exposure to a bunch of different things with one single transaction, as opposed to you having to go out and buy all of these companies yourself. All right. Let's go back to why we said you could technically get a higher return than the RoboVadis stuff. Using the SIFE, so what you're seeing here is the SIFE 100% global equities, right? And on the SIFE website, it actually shows you every single ETF that they personally invest in using your RoboAdvisor money. And therefore, you can now, if you don't want to pay SIFE for their services, which is about 0.6% or 0.65%, you can technically go and buy all of these yourselves, right? So technically, you can get a higher return. But yeah, whether or not it makes sense, that is really up to you. Something else that we want to make sure that you also understand between RoboAdvisors and, in a sense, now we're talking about the DIY space. When it comes to options, RoboAdvisors, much more limited compared to DIY. You can buy anything, everything, and then, however you want to do it, right? With RoboAdvisors, it's just one simple fee that you have to pay. And, it's already part of your investment, so you don't have to pay it anymore, right? Whereas with DIY, if you're buying something in the US, you have to transfer your money from Sing dollars to US, so there's some sort of conversion fee. When you're using a brokerage account to buy, you're technically paying the broker some sort of fee as well. And then what you're buying and how much it actually is worth might be slightly off. So you're also losing a bit more from there, right? So it can really add up if you really don't know what you're doing. Something for you to just be aware of. RoboAdvisors, 10 out of 10, flat out beginner friendly. DIY, more like 1 out of 10. But of course, once you kind of learn a bit more about investing DIY style, it can be closer to an 8, right? When it comes to returns, you can look at the RoboAdvisor guide here. And of course, when you're DIYing, the potential can be a lot higher. Of course, the downside can also be a lot scarier since you would need to know what you're doing, right? That's all we're going to talk about when it comes to ETFs and all that. Something that we do want to leave you with as an additional bonus per se is this retirement calculator. This retirement calculator is actually already in the RoboAdvisor guide. Let me just share this screen again. So this retirement calculator will show you roughly how much you would need to invest every single month, starting now, if you want to have a very specific retirement. So let's just say you're 60 years old right now and you're hoping to retire at 65. You expect yourself to live until 88 or 90, right? And ideally, you want to have, let's say, like $5,000 a month once you actually retire. And let's say your goal is to aim for a 5% return, right? Click this button, and now you will see that you will need to be putting aside $780 a month starting today in order to have all of these goals that you set out. So that by the time you reach the age of 90, you will have pretty much no money left, right? So this is here just to give you a really quick idea in terms of how much you actually need to retire, how much you can, from an investing perspective, how you should start thinking about investing and all of that, right? So the way you want to invest each of these things is very different, right? And of course, even within the 5+ years out, you probably want to have a few different options so you're not heavily reliant on one thing. That is why we want to introduce something called position sizing here, right? The idea of position sizing is that you don't want all your eggs in one basket. In this specific scenario, you don't want all your retirement investments going into one specific product, right? You want to have a mixture in case something were to happen. And what we're saying here is, some of these things you might want to be more aggressive for your returns. Some of them you might want to be able to get some more dividends on your day-to-day basis, right? But because we know how much we should be putting away for retirement and what type of returns we're looking for, we can use the Robo-Advisor test portfolio to create a mock portfolio to see if you can actually get the type of returns you need in order to create the life that you're looking for, right? That said, that's all we want to say about position sizing at this point. Make sure you play with the guide, explore all your options, see what makes sense for you, and all that good stuff. Besides that, we actually have created something very new and something I'm very excited to share. So in this version of the Robo-Advisor one, we were only able to talk about robo-advisors, and there's just a lot more limitations, right? However, what we have created here is something that will actually allow you to put out different assets. So you can actually pick specific stocks that you want to invest in. Maybe you want to have a bit of Bitcoin. Maybe you have some sort of Singapore property that you'll be, you're looking as an investment, and you're just here in this case where your mortgage payment and fees will just be your investment that you're putting away, right? And what that actually allows you to do is you can create your own portfolio, and from that portfolio, we can actually create a mock experience as to what it would have done over the next 10, 20, 30 years, and see how you actually feel about it, right? If you had all your money in Apple, would you actually be okay with it? Or if you had all your money in other things, would you be okay with it? So here you have a chance to each year see how it would have done, and then kind of tell or say how you would have felt about it, and then move on to the next year, right? So kind of giving you a glimpse into the future, a potential future. I do want to make sure I emphasize this is a potential. There's no way we know exactly what's going to happen next year or even tomorrow, really, right? One last thing that we want to share quickly here is you can then see how your investment would have done as a graph, as opposed to just a table, right? And see for yourself that it follows the same trend overall, but there's a lot of ups and downs, right? It's not a flat, smooth ride all the way up, right? So giving you an idea in terms of, if you were to have gone with this, would you have been okay if in this example here, let's say in 2042, your portfolio is worth about $20,000, or rather, let's say in 2044, your portfolio is worth $200,000, but then in 2052, it would have been down under 200,000. So 12 years and you would have lost money. Would you have been okay with that, right? And then seeing that, like, oh wait, things actually go up again, right? So that is what we want to make sure you have a chance to see for yourself, experience for yourself, so that you are way more prepared for the realities of investing. So we're calling this the Personal Investment Crystal Ball, and it's something that we will be charging for $99. But it is included in our investing course, all right? And with that said, I'm going to leave it to my future self and Joey to talk more about the course, what it actually entails, and if it's actually a good fit for you. Okay. All right, so Joey, can you go to the next slide here? Next.
I just wanted to say My design is so cute, right? Okay, next.
Yes, it definitely is. Okay, I think one thing we want to make sure you guys are aware of, we are coming closer to the end of the workshop, and we'll be answering a bunch of your questions in the next, I think, 2, 3 slides time. Just want to talk a bit more about what we've actually been able to do, right? In this case, what the course that we've created, we this is actually how much we actually were able to get through today. Not actually a lot, and I think the most important ones are the last two, like actually understanding all the different investment vehicles. I saw a lot of questions at closer to the end talking about stocks, about brokerages. So those are all things that we would definitely be covering in a lot more depth. And of course, at the end, really developing your own investment strategy. I think right now we're starting to show you how you can do that by creating your own portfolios, understanding that different money has different purpose, or the way you invest will be very different from one goal set of goals to another. So how do you actually create an overarching investment strategy that actually fits your long-term goals here? Okay, so that's really yeah. So in other words, we haven't really been able to cover as much as we would like to cover in a workshop. So that's why we decided that a course is probably a better fit in trying to get out all the information that we think is actually important to know. Next. So who is this course for? I think we should go back 2 slides, actually, before we actually go into this. So we call this the Non-Finance Bros Beginner Investors course, right?
No offense to any finance bros that might be here, but yes, because we are both not finance bros. Yeah.
Yeah, and I think that said, I would assume most of you here are also not finance bros. Otherwise, you probably wouldn't be following SAP, right? I think a lot of the courses that are available to learn how to actually invest are so focused on that audience that it's really hard for people who don't resonate with the way they talk to really fit in and get the information that they need to become successful. Which is why if we move forward 2 slides, um, this is kind of what we were talking about. Who do we think this course is actually good for? People who feel like they aren't very good at math. We are really tried reducing all the. I don't think there's actually much math that you actually need to understand. It's just getting more comfortable with accepting that these are numbers and then just working with it as opposed to trying to figure out how these numbers came about. Um, Second one here, if you feel like you're excluded from all these different investing courses, like we mentioned, if you don't feel like you're a finance bro type of person, I think this is also a good fit for you. And yeah, we also, I hopefully, based off your experience with our workshops, you can have a rough idea that we have tried reducing all the lessons to as simple as possible, whether that was budgeting, whether that's insurance, or today with investing. So we have really created this course with you guys in mind. Joey, anything you want to add about
Yeah.
this?
And I will be running a course. So if you like my vibe, okay, basically I just want to say I suck at mathing too. I am also a woman, and I am also not an investing like guru that you see in all these other courses. So everything that we are covering in this course can be understood by like a regular human being who sucks at math or just like anyone really. So it's going to be very visual. We have a community that you can join, and everyone will be on the same level. It's kind of like fun, right? Going through the course with other people, and you can ask questions and chat. So yeah, if you feel like you're one of these people, I think the course will be pretty suitable for you.
Okay. Next slide. So these are all the things that we plan on covering over the course of a month. Clara, I just saw your question. What day and time does this course begin? Sorry, yeah, we never added that in. Totally forgot to do that. But it will begin on, I think, 4th of Feb. It's a Sunday, right?
Let me just add something here. So the course is actually a self-paced program, we are going to do a couple of sessions live, like just to introduce everyone. And also we have a few Q&A live sessions in between that are obviously live and at a set timing. But there will be replays, first of all, and the modules will drop at specific timing, but everyone will get access to them, so you can go through the entire course at your own time.
Yeah. And going back to the initial question, Clara, that you asked, the course starts on the 4th of Feb. And I think we plan on releasing two or three sessions a week over the course of a month. So yeah, just think of it as 2 sessions a week. And like Joey said, it's self-paced. We have the SAF community for you to continue to share your own thoughts and insights along the way. Okay. Next slide, please.
Are we not going through this slide?
Oh, sure. Go for it. You want me to,
Okay, so we'll just go through the modules briefly. I mean, you can see it here. So which ones are the live streams, and also what we're going to cover. So basically, we're going to go deeper than we've gone this workshop. We're going to go through all of the basics of investing, what you need to actually get done before actually starting investing, figure out what type of investor you are, and from there on, what investment options you have as an individual. And also in the same course, you'll be able to design your very own investing strategy. And basically, what we want is when you get out of this course, you would have started investing, or you would start investing, because you would have had everything prepared and done throughout this 1 month. Yeah.
And of course, it wouldn't be SAF if we didn't add some additional very cute things along the way. So we already talked about the investment crystal, investment crystal ball, where you have a chance to create your own portfolio and actually test it over the course of time and see if it fits your objectives, right? Besides that, we understand that there's a bunch of investing lingo that it gets very confusing, which is why we've created a guide that will also help give you a breakdown in terms of what everything actually means, so that next time your finance pro talks to you, you're not completely clueless and you can have a rough idea as to what's actually happening. Besides that, I think the investment vehicle handbook, I think you can think of it as what we covered today with robo-advisors is pretty much that one section, a robo-advisor section in the handbook. And I believe we've found maybe 10 different types of investments that we would go into that level of depth, so that you would then fully understand how each thing actually works, what to actually consider, and how to actually take action if you so desire. And of course, the last thing here, Joey, you want to talk about it?
No, you can talk about it.
Okay.
I have something else to add later.
Okay, sure. Yeah, and of course, our main thing here is we'll be putting everything on the SAF community, because that is really where, we want to make sure we're going through it together, and not, even though it's self-paced, it's not supposed to be something that you go on a solo journey. We want to make sure you guys have a place to share your experiences, ask your questions, and learn from each other really. So that's why we have created the whole reason why we initially created this whole space of the SAF Club was to be able to do this with you guys here. That's it. Joey, take it away.
Yeah, and just wanted to emphasize again that you will get access to the SAF community forever, and the course content and resources forever as well. So it doesn't just end when the course ends. You can still share your journey, ask questions even after the course ends. Any tips you want to share on investing, or just share with other people. And also, if you're a follower of SAF and you just generally like, our aesthetic and our style, all of these resources are designed by me, and they will be very cute. Yes. That's all I want to say.
All right. I think we have one more slide. Okay. So how much is actually going to cost? Honestly, most investing courses out there are in the hundreds of dollars. Ours, we want to make it as accessible as possible, while at the same time making sure that, as SAB, we can actually sustain ourselves, right? So that said, we are looking at, or the course is actually $199 flat, which is really just about $6 a day. Next. Of course, everything that we are sharing, that you can technically find this online, go on YouTube, there's a bunch of this information. We're not trying to say that what you're going to hear from us is going to be something that's like a secret that you're not going to find anywhere else. But what we are saying that is we have taken the time to sift through all the hundreds of hours of content to put it in a way that makes it easy for you to understand, right? So that you're not the one who has to go out there and figure out what you don't understand, figure out who to trust, and then try piecing it all together. So this is really the course. It's just a streamlined, efficient approach to really get you started investing. And of course, the last thing here, we are offering all of you guys a $50 discount for the next 3 days if you use the promo code bonus50. I think if you press the button to buy, it's already automatically applied on this page. And for some people, $200 or so might be a little too much to put out upfront. We have created a way for you to split your payments into either 2 or 3, and then the $50 would just be applied to that first payment. So in a way, you could also start this whole thing on like $30 or something like that, right? And the last thing that I do want to emphasize is that we really want to make sure that this is actually going to be the right fit for you, and we will let you decide if that's going to be the right fit. So if after the first week or so, if you still feel like this is actually not what you thought it'd be, you can totally get your money back. Joey, anything you want to add about this?
Yeah, and we also have one more discount if you do bring a friend. So if you sign up for yourself and a friend, it's going to be an extra 10% off. So yeah, could be a good friend thing to do, like a good birthday present or something. Yeah. Okay, I
Okay.
think this is the end of the workshop. If you guys are interested in signing up for the course, you can see the details below. We will also be sending out an email and message to give you to get you a link to a site where there's more information. So take the time you need to think through if the course is the right fit for you, if you want to start investing. And yeah, anything else to say, CS?
No, let's answer some questions.
Okay, thanks for listening to us talk about the course. We'll answer the not last few, we have quite a few, but we'll go through the rest of the questions. And if you still have any more questions about what we covered today, or if you have questions about the course, you can also ask us now. Okay, let's get through the question. Okay. From Min, I think this one is quite interesting. What is the end goal of capital gains investing? For dividend, we strive to gain sufficient passive income. What about capital gains? Do you just withdraw everything all at once?
Okay, so I think ultimately the objective of investing is really to make sure that you have the money you need to live the life that you're looking to live. And at the same time, you are, how do I put this? You are going to be set for your future as well. Okay, so how you go about that is completely up to you. You can just use dividend investing the whole way, and taking that additional source of income, and that's it, right? And that's all you have to do. Another way you could do it is you really go for capital gains first, because usually with companies that pay dividends, they're probably not going to be growing as fast anymore, right? Which means that your returns you're not really going to get capital gains from your dividends as much as you would get from a tech company like Apple or something. Well, I guess Apple pays a dividend now, but like a Tesla or something like that. So usually with capital gains, once you actually sell it, then the question is, yes, do you invest it in dividends? Do you just invest it in SSB? Do you invest it in other like safe investments, or do you just leave the money because you don't even need to think about it anymore because you're filthy rich and that inflation is not going to impact the way you live your life. Those are all kind of your own decisions once you actually have all that money. But I think most people who have, let's call it a windfall, like a lot of money like to use all of a sudden, they are usually the ones looking for some sort of dividend to make sure that they can then turn that, let's say, $1 million into a way to have a passive income every single month or every single year.
I think we have one new question by ILT. The robo-advisor guide that we shared just now, yes, it will be available in SAF Club after this workshop. We'll put the link up. We'll also send out an email with the link as well as the course information. So just keep a lookout for that. And also Dorothea has a question on the retirement calculator. How do you know like what expected annual return to put in? Yeah, that's the one.
Retirement. I think this is what you are aiming for. So once you, okay, let me try sharing my screen again. Let me just find the right thing here. Am I looking at the right thing? I am looking at the right thing. Okay. So Dorothea's question is, what do we do about this number? How do you know what to put in? This is really the key thing that's going to make a difference between, let's say, how much you need to put away each month. Okay, so if you, let's say, for example, you're saying, oh, what if I can get a 6% return, how much do I need to put away every single month? And in this case, it says you need to put away $573. And now if you say, oh, how about 7%? How does that number change? You can see that it went from 570 to 420, right? So that's like a $150 difference. So that is the kind of gives you a rough idea in terms of like what you should be aiming for. And then using this number, you can then look back into your robo-advisors and see, were there any robo-advisors that can actually give you a 7% a year type of thing? And in this case, it seems like Endowus the last 10 years was able to do that with this product, this product, this product. So yeah, it gives you a way to kind of create a hypothetical portfolio and how you can think about investing for yourself. Okay. Okay, so.
Okay, I hope that answers your question, Dorothea. Natalie asks, is there actually a difference between each robo-advisor and is any one better than the other?
Oops, Natalie. We covered this earlier, so I'm assuming this question came in before we went into this. As a whole, it's based off what I was able to find. It seems like the Stashaway was kind of the weakest of the three that we covered. So yeah, I mean, that's really the only thing that I can really say, but it doesn't necessarily mean that it's not going to be the right product for you, right? We never went to as much depth there. I think in the course itself, we'll be able to go into more depth in terms of how each of these companies have kind of positioned themselves and what their goals are. And then from there, you can kind of decide what you want to do. Otherwise, feel free to do your own research about that, or use the robo-advisor guide to figure out whatever, as a baseline for your research.
Okay, one from Era. What's the best investment strategy or platforms for children's education if I'm not considering endowment?
So children's education, I almost view that the same way as like all your other your buckets, right? So is your child education is something that you're going to use in under 2 years? Is it going to be something that's in 5 years time, or is it going to be over 5 years, right? If it's over 5 years, then of course the goal here is to be more aggressive with it, invest it in the more the 5+ years things that we've listed out on the robo-advisor page. or invest. You can essentially invest it however you want, with the intention of allowing time and compounding to work for you. So that said, when it comes to platforms, I think the platforms are ultimately going to be a question of, do you want to use a robo-advisor and have it automated, or do you want to use a stock brokerage and then invest it yourself? Joey, you're muted there.
Oops, sorry. I was reading the question from Gab. How do you determine when to withdraw your money or stop investing for longer term investments? I'm assuming this one is for like 10 plus years out.
Mm-hmm. I would say the way you could approach it, as a rule of thumb, of course, is to look at going back to the 3 buckets, right? We have under 2 years, we have 2 to 5, and then we have 5 plus. So when your goal went from 5 plus to now 2 to 5, then the way you invest that money should change as well. And then when it's gone from 2 to 5 to under 2 years, then that's when you should be pretty much taking no more risks, right? And then just bringing that into a more guaranteed type of return, or not trying to invest it at all anymore. So that's kind of how I would suggest you approach that. And then, of course, I think once you go down that journey and then you kind of see, like, maybe let's say your goal to retire, or your goal for let's say 7 years out, is to be able to afford, put a down payment down for your property, and then this year or later this year your stock investments or whatever did really, really well. Then of course I would say then you don't need to put all that money and continue to risk per se, right? You've already kind of hit your goal. You can reduce your risks and kind of lock in your opportunity to buy that property or put that deposit down.
Okay, Calv, a generic one. How do I get started with stock investing?
So to get started, I guess the 2 ways to look at it. How do you technically get started, and how do you mentally get ready to get started? So how do you technically get started? You open up a brokerage account. So that will be someone sent us a DM and essentially open one of the animals. So your moo, your tiger, what have you, the stock brokerages, and then put some money in, and then you can start investing right away. How do you get started mentally? I think that's going to be up to you to decide whether or not you're ready for something like that. If you have the right information, if you are mentally and emotionally prepared for the ups and downs that comes with investing, and stock investing in particular.
Okay, any more questions, guys?
Amy has something here. Amy, can you withdraw your CPF SRS funds from Endowus back into your CPF account? What happens if Endowus fails? So answering number 1, yes, you can withdraw your CPF and SRS funds from Endowus back into your CPF. So they are really well connected from that perspective. What happens if Endowus fails? So this is something a bit more technical, but when you invest through Endowus, it's not that Endowus doesn't actually hold your money, right? Your money is actually left with what's considered a custodian, and with Endowus's case, it's with UOB, Kay Hian. And so if something happens to Endowus, UOB actually has all your money, and they are able to then give it all back to you.
Okay, I think those are all the questions we have. Okay,
One last one here.
30 more. Oh, I replied Jia Hong already, but if any of you guys want to see the program syllabus or the outline, okay, we are going to end a workshop soon. So currently it's there on the page if you scroll all the way down, but we're going to send you guys all a link after the workshop, as well as putting it up on SAF Club, so you can have a look. And if you have any questions, you can also post it on SAF Club directly. Yes.
All right. And I think we hit our 2 hour mark just right on time.
Yes, and with that, Money Spring Cleaning is officially done for 2024. Yay! Congratulations. All of you guys have done the spring cleaning extremely well. Your money is hopefully now very clean. Your thoughts are clear, and you can go on the rest of the year knowing what to do with your money, your budgeting, get your insurance settled, and hopefully start investing. Yeah, thank you so much for joining us for the past 3 sessions and also asking us all the questions and chatting with us on Slido. Anything you want to say, CS?
Yeah, just thanks so much. Like Joey mentioned, it's been really getting to see some names in Slido. So it'll be kind of sad to not be able to hear from you as often. Of course, the SAP Club is always there for you. So please do continue to share your thoughts, share your experiences, ask us questions there. I think we'll be doing a lot of more interesting things in SAP Club that you won't be able to find on our Instagram account. So do stay in touch there. Yeah.
Yes. And with that, good night to everyone. Hope you have a very good rest of the week. And thank you. And also, if you want to see more of us, you can join the course. Okay, bye.